all sources of wealth must contribute equally for calculating total taxable wealth. So this includes cash, of course. It includes securities as well as land and buildings, any vehicles, boats, airplanes, etc. It includes appliances and equipment, trusts or businesses, as well as artworks and patents as copyrights, or basically anything else with financial value that is non-liquid. All types of assets must be added together to calculate total wealth. People are then free to choose what type of wealth they wish to accumulate to stay within the overall maximum limit. Minimum and maximum wealth levels must be linked to each other by a ratio, same as income. The issue is establishing a minimum wealth baseline to anchor this ratio. There are many potential ways of deciding the minimum. A simple approach could be the average total wealth of the poorest 1% of the adult population, and this would be a fine approach. However, we could use this opportunity to define the minimum in a way that helps eradicate involuntary homelessness. The minimum wealth would be the value of a simple two-bedroom residence. This approach establishes a minimum wealth that nobody falls below. People would of course be free to work towards building wealth and living in bigger homes, but nobody would become homeless. The minimum would apply to each individual adult. People living together could then combine their minimums to, for example, live in a modest home suitable for a family. Groups of people or even extended families could combine their minimums to co-own bigger homes if they wished. Of course, others can just work for bigger homes too. Giving homes to the homeless is the cheapest option for taxpayers. It's cheaper than not providing homes because homeless people often require police, justice, medical, social, and other services at higher rates than non-homeless people. Providing the homeless with homes lowers the burden on government budgets by reducing the level of need for those services. It avoids unnecessary bureaucracy and reduces the ongoing costs of managing social housing and providing all the associated services. Giving people homes is a simple solution to a problem with more complex causes. It also enables solving other social problems. For example, children have a better chance to grow up in stable homes rather than go into foster care systems if their parents become homeless. This further reduces the burden on taxpayers because there will be less need for social workers, services, and other costs associated with caring for children from unstable homes. Moreover, instead of these people growing up to have chronic mental and health issues, requiring more resources over the long term, they are instead more likely to become healthy, contributing members of society. This means fewer government services are needed and government budgets are smaller, while more people would be able to contribute to society. Taxpayers would therefore not only save money, but the tax burden would be shared across more people contributing to society and the tax base. Giving small and simple homes to the homeless is thus a financially responsible method of establishing a minimum wealth baseline. Homes given to the homeless would eventually become their own personal property, so that it is in their interest to look after these properties. It might be psychologically better as well to allow people to buy their homes at cost without interest, so people worked to earn their homes. People might value them more this way and look after their own personal property. However, in the first instance, homeless people would be housed without needing to pay. From that position, their lives would become stable and they could seek employment. They would then be given the option to work towards the purchase of their own home. Keep in mind that this may not be possible for everyone, and that there will always be a small percentage of the population that needs more ongoing help for a variety of reasons. The minimum wealth value held in primary homes must never be available for collateral. Anyone with only one home could not sell it without simultaneously buying another home. Alternatively, they could have the minimum value placed in an inflation-adjusted trust to buy another home later. For example, people may not want the responsibility of a home if they go traveling for a long time or move overseas for a while. However, they cannot withdraw the minimum wealth value to travel, and they cannot have this minimum value in cash, even if they move overseas permanently and they give up their citizenship. The reason for this is that people can come back. Anyone who used to be a citizen can reapply to be a citizen in the future. This is why no one can withdraw this minimum value. The idea is that nobody in the country can fall below this minimum wealth level, lose their home, or become involuntarily homeless. Defining minimum wealth as having a simple home also provides people with an address for voter registration, employment searches, and other public services. So the solution fits within and complements a broader set of changes to build a better society. These are the other things that we talk about in this channel. Once a minimum wealth level is established, the maximum wealth would be set as a ratio of this minimum. It is essential that the ratio be set democratically after hearing independent expert advice and relevant research. However, using a 1 to 1,000 ratio as an example, if a basic 2-bedroom home costs $200,000, the maximum wealth level would then be set at $200 million. Linking the maximum wealth to a minimum wealth motivates the wealthiest in society to push for the minimum to be increased. For example, if the minimum wealth level increases by $50,000, then the wealthiest can have an additional $50 million. Minimums ensure people cannot fall below a certain level, but it is more important for a stable society that people are not able to exceed a maximum level of wealth. Some people always seem to want more, and no amount of wealth is enough. But too much concentration of wealth is detrimental to the health and stability of society. There must be a limit beyond which society tells its members that they have enough, even if the individuals themselves, of course, disagree. Freedom to pursue individual interests, such as accumulating wealth, must be balanced with freedom from the deprivations that come with wealth inequality, such as homelessness. A progressive wealth tax must be implemented to reduce wealth inequality. It must be a progressive tax because the wealthier a person is, the higher returns they are able to earn on their accumulated assets. Wealth inequality is more extreme than income inequality because it accumulates over lifetimes and generations. Without taxing wealth, society gradually splinters into elites owning almost everything and the rest of the population sharing the remaining scraps. This is not a stable arrangement and historically leads to societal breakdowns and mass violence. We are doomed to repeat this cycle again unless we learn from it and implement a progressive wealth tax. The marginal rate that applies to each bracket must increase exponentially and not linearly as it does with income. The first marginal tax bracket must have a rate of 0% because it applies to the minimum wealth bracket. If we tax the minimum, this would erode the value of this wealth and push people below the minimum, defeating the goal of having a minimum in the first place. The wealth tax then starts with very low marginal rates in the first taxed bracket, increasing very gradually at first for brackets in the middle, and then the rates accelerate quickly to a maximum marginal rate of 100% for the last tax bracket. Then all wealth beyond the maximum is taxed at 100%. The marginal rate must increase exponentially because wealth grows exponentially over time. Marginal income rates can increase linearly because income is a steady annual flow, more or less. Wealth usually grows faster than inflation, whereas income growth has not kept up with inflation, meaning wage earners have gradually become poorer in real terms. For example, someone with $1 million invested in assets receiving a 10% interest rate will double their wealth about every 10.2 years without working. However, someone working full-time for an income worth 7% of $1 million or $70,000 per year will only earn $714,000 during the same 10.2 years. The $286,000 difference is due to compound interest accruing on wealth. And remember, the person with the wealth didn't do any work. The difference becomes more extreme over longer periods of time and with greater levels of wealth. Marginal tax rates that increase exponentially for each bracket of wealth take this reality of wealth accumulation into account.